Okay, what I want to do today is just give you, a real short tutorial on how to set up, options, weekly options. And this video is going to be more on how to think, and it's going to break it down into simple terms of really what you're doing. I'm not going to cover a lot of Greeks and all that, you know, because, the thing that's going to determine whether the option's in or out of the money is basically, the issue of whatever you're trading, if it's above or below your strike. So let's say that, we'll use this as an example. And this is a weekly chart, which means, it's 5 days. So what I do is I just take like the ATR and I just set the ATR length to 1 on a weekly chart, because then that's one candle, that's 1 week, that's 5 days, and I can get the average true range of one candle, which currently now is about 70 points. Okay. So let's say, for example, I wanted to do, I felt the market's going to go down more, so I would do a call. I'd want to sell a call. And so I could go like, all right, the low here is like 1812, whatever. I would say, okay, this is resistance. Okay. Um, or I could look, say, at the high of, we'll call this a Monday. Today's really Thursday. We'll just call it Monday. And since the ATR is about 70 points, it's going to move in a week, which is the current volatility, and range and all that. I'm at 1882, so about 1880, 70 points would be about 1960, which you can see right here. There's 1950. 1960. Be around right there. Okay. So then I would just go look for, about a 1960 call. And, I could see here, it's got a 25-cent bid, and it's got about a 99% of landing out of the money, which is pretty good. And I got a really low delta and all that kind of stuff. So then, I would look for maybe a 1960 call. And if I did the 60, I would have to sell the 60 and buy the 65, which is about 10 cents. Give me about a 15-cent premium. So if I go over to the verticals, 1955. 1955, 1960. So that would be about right. It'd be about, see, 15 cents, 150 rewarded. Um, say 10 contracts. It'd be about 300 bucks credit, which is, if you pulled the thing up, you'd come up here and there's it's your limit price, shows you its credit and all that kind of stuff. And see, the important thing to know is basically what you're doing is you're trying to find a strike price that will not get hit. Okay? And then you just find a spread between the one you sell and the one you buy, where you can get some premium, 15, 20, 30 cents or whatever. Okay? So if the market moves down, I'd want to do calls. But let's say the market wants to move up. So, the low of what we're calling Monday here is about, 1810. And so about, minus 70 points would be about 1730. So that would be the strike I would pick. Would be a 1730 strike. And then, I'd go over here. And I would do the, see where I can get some premium on the put side. Um, which should be 1730. About 98% out of the money. And, so that would be pretty good. And then you'd say you'd be selling the 30 and you'd be buying the 25. So that's about 40-cent premium because you see 370 and 330, about 40 cents premium. But really, the strike you're picking to not hit, the one you sell, is that's the one you got to be concerned with and you watch. That, it expires out of the money. You can't have it, if you're doing puts, you can't have it below there because the put it go into money, and it can't go over to calls or the call go into money. And you want these to expire out of the money. So then that's your strike. And then the other one you pick is just your hedge. And you hedge it because of margin and risk management and all that. And you see up here I did one, and it's I sold the 1920 and it made 1750, and I bought the 25 and it did it 1500, so that was about 250 bucks. And that's basically it. And I just want you to understand, if the market's going down, do calls, pick a strike that it won't hit, above some kind of resistance or something. And then the other one's just your hedge. The one you buy is your hedge. Same thing. If the market's going up, you want to sell a put and then just buy a hedge, where you can get some spread. And you're going to be in the market 5 days, so look at your ATRs. And I hope that helps you out and just makes it simple. Uh, you know, rather than complicating everything. And the reason you do this is so you can get two things on your side. One is price movement, the other is theta, time decay, you know. So you have two things working in your favor then. Price movement and time decay. And then that should make you a little bit more of a successful options trader.